Very good. Thank you, ladies and gentlemen. So on behalf of the Australian Chamber of Commerce and Industry, welcome. I would like to begin by acknowledging the traditional owners of the land on which we meet, the Ngunnawal people, and we acknowledge and pay our respects to their traditional custodianship and continuing association with these lands. And can I extend today a very warm welcome to any First Nations Australians who are with us today. I also acknowledge members of the international diplomatic community in Canberra who are here with us. A warm welcome to you. Welcome also on behalf of our co-hosts, the Canberra Business Chamber, who are actively representing the interests of business in the nation's capital, and in particular to my friend Graham Katz, CEO of the Canberra Business Chamber, and to Archie Siramokas, President of the Chamber, who we'll hear from a little later in the proceedings. I would also like to acknowledge today Karen Sobels, who is an ACCI board member and also President of the Victorian Chamber of Commerce and Industry, and most importantly, a constituent in the federal electorate of Kooyong. At ACCI, our mission is to mobilise ideas, influence and the passion of business to achieve policy outcomes in the national interest. We will do that at every opportunity, and there is no time like the present. In just 11 days, the Treasurer, Josh Frydenberg, will present the federal budget, and from there, we expect it will be a short dash to a federal election. As we approach that forthcoming federal election, ACCI will be there to remind the major parties and the public that business is the backbone of the Australian economy. If we are to strengthen the economy and drive better living standards in the next term and beyond, we need a clear plan to back Australian business, to invest in skills, to create jobs, to boost business, and to provide a foundation for small business to grow and prosper. I'm sure you will hear much more about these themes from us over the coming weeks and months. But for now, it is our great privilege to invite Federal Treasurer Josh Frydenberg to deliver his traditional ACCI pre-budget address on the fiscal strategy that will underpin the forthcoming federal budget. Welcome, Federal Treasurer Josh Frydenberg. Thank you.
Well, thank you very much, Andrew. Firstly, can I begin by acknowledging the traditional owners of the land and pay my respects to their elders, past and present. And can I acknowledge, Andrew, you and through you, ACCI and Karen and Archie and Graham, with your presence today. It's much appreciated, but most importantly of all, ACCI, with its 300,000 strong business membership, is acutely aware of how severely impacted small and medium-sized businesses have been through the pandemic, but also how indispensable they are to Australia's strong economic recovery, and they are very much at the heart of our economy. But as always, Australia's SME sector has shown remarkable resilience, and therefore it's a great pleasure to be here with an ACCI audience to make some comments about the fiscal strategy as we approach the budget. In 11 days' time, I will deliver my fourth budget as Treasurer. Budgets that have been delivered in the midst of fire, floods, drought, a global pandemic, and now war in Europe. Extraordinary events that have tested Australians, but also brought about the very best in Australians. Our thoughts are today with those families affected by the devastating floods across New South Wales and Queensland. The Morrison government will continue to stand with these families and communities as they rebuild. In my pre-budget address today, I will address two key points. First, the Australian economy has recovered strongly and now has real momentum. The initial phase of our fiscal strategy has delivered on its objective, with full employment in sight. The budget I hand down on the 29th of March will show the fiscal dividend of our strong economy. Second, with our economic recovery well underway, it is now time to move to the next phase of our fiscal strategy. This will see a focus on stabilising and then reducing debt as a share of the economy, rebuilding our fiscal buffers without risking growth. In early 2020, Australia faced its biggest economic shock since the Great Depression. Around 1.4 million people, or a little more than 10% of our workforce, lost their jobs or were stood down on 0 hours in April 2020. Our economy shrank by an unprecedented 6.8% in the June quarter. To put this in context, prior to this, the largest ever quarterly fall in GDP was 2% in the June quarter of 1974. People were confined to their homes. The economy was put into hibernation, and our lives were put on hold. In the face of this crisis, it was clear that we had to recalibrate our fiscal strategy, a strategy that had delivered the first balanced budget in 11 years and put us in a position where we were able to respond on the scale that was necessary when the crisis hit. Our sole focus was on saving lives and livelihoods and preventing the Australian economy falling into the economic abyss. To achieve this, the first phase of our updated fiscal strategy supported employment, growth, business and consumer confidence, with temporary, targeted and proportionate economic support measures like JobKeeper, the cash flow boost and the coronavirus supplement, which doubled the safety net. This has seen $314 billion in direct economic support from the Morrison government alone. Unlike during the GFC, when a 425 basis point reduction in the cash rate provided the equivalent of $100 billion economic stimulus over a 12-month period, this time, during COVID, monetary policy had very little room to move. Fiscal policy was relied upon to do the bulk of the heavy lifting. We were clear in our October 2021 budget that this first phase of the fiscal strategy would remain in place until the economic recovery was secure and the unemployment rate comfortably below 6%. This was not forecast by Treasury to occur until the end of 2023. When I spoke to you ahead of the budget last year, there were promising signs of the economic recovery, but it was not yet secure. While the unemployment rate had fallen to 5.7%, well ahead of expectations, it was still important to reassure households and businesses that fiscal support would not be prematurely withdrawn from the economy. The strength of our recovery has also created a historic opportunity to drive the unemployment rate down to not just pre-pandemic levels, but even lower. It was an opportunity that we needed to seize. So we adjusted our fiscal strategy accordingly. Today, ladies and gentlemen, we can see that our fiscal strategy has worked. Australia's unemployment rate is now at 4%, the equal lowest in 48 years. There are 377,000 more Australians in work today than at the start of the pandemic. The unemployment rate is now on track to have a 3 in front of it for the first time in half a century. This is a long way from the 15% unemployment rate that Treasury first feared in the early days of the pandemic. Australia has avoided the labour market scarring that was so reminiscent of our experience during the recessions in the 1980s and 90s, where it took up to a full decade for the unemployment rate to recover to its pre-recession levels. This was not only a test that we set ourselves to see a fall in unemployment, but it was also a test set by Shadow Treasurer Jim Chalmers, who said, I quote, "What happens to jobs is the biggest test for this government's management of the recession and its aftermath." Beyond the unemployment rate, there are broader signs of economic growth. Growth in the December quarter was its equal strongest in 46 years. Businesses are investing, with capital expenditure expected to grow by more than 12% this financial year. Job advertisements are more than 45% higher today than pre-COVID levels. And in my EFO, wages were upgraded in each year of the forward estimates, with the latest national accounts showing average earnings up 3.4% through the year. Omicron may have temporarily interrupted the recovery, but it did not derail it. Spending data for January and February was actually up on the year prior. To the credit of 26 million Australians, our economy has outperformed all major advanced economies in the world in both employment and output terms. Our recovery has been stronger and faster than that in the United States, in the United Kingdom, Canada, Japan, Germany, Italy, and France. A number of those countries cannot point to employment that has recovered to even pre-pandemic levels. It is this underlying strength and resilience of the Australian economy that now enables us to transition to the second phase of our fiscal strategy. The time for large-scale, economy-wide economic emergency support is over. Fiscal settings need to be normalised. We have already drawn some very clear lines. We ended JobKeeper in March of last year. At that time, it was costing taxpayers more than $2 billion a month. The Leader of the Opposition called for JobKeeper at the time to be extended and expanded, saying JobKeeper, and these are his words, was the only support that was keeping the economic roof from crashing down. A false prophecy indeed. 3 months after JobKeeper ended, 120,000 more Australians were in work. We also ended the COVID disaster payment last October as restrictions eased after the Delta outbreak. Again, Labor opposed us, with Shadow Finance Minister Katie Gallagher then saying, and I quote, "Support should not be pulled." The following month saw 373,000 new jobs created, the strongest monthly increase on record. And earlier this year, we took another hard decision, turning down state requests for more broad-based economic support during Omicron, noting the underlying resilience of the economy and measures that were already in place. Labor again called for the spending taps to stay on. A month later, the unemployment rate fell to a 13-year low. Labor has made $80 billion of additional spending commitments during COVID. Once Labor starts spending, they don't know how to stop. Crisis-level economic support must not become entrenched. With our tight labour market and our strong economic recovery, continued support at those levels would do more harm than good. It would risk putting further pressure on inflation, interest rates, and cost of living. International factors, including rising global oil prices and shipping costs, have seen our inflation rate increase to 3.5%. While inflation in Australia is less than half of the 7.9% seen in the United States, and well below that of the United Kingdom, Canada, Germany, and New Zealand, cost of living pressures in Australia are real. What Australians cannot afford at this time is a Labor government who, when last in office, mismanaged the economy, seeing unemployment rising from 4.2% to 5.7%, electricity prices double, and taxes increase. Our plan to reduce cost of living pressures has focused on a number of measures, including driving electricity prices down by 8% in the last 2 years, record investments in childcare of over $10 billion a year, and around $30 billion of tax relief since the pandemic began that has supported low and middle income earners. In the budget, in just over a week's time, there will be further measures to support families meet the cost of living pressures. We will do so in a targeted and proportionate way. In the second phase of our fiscal strategy, we will target a budget position that allows us to stabilise and then reduce debt as a share of our economy. This year's budget will confirm that this is the trajectory that Australia is now on. It will show a substantial improvement to the budget bottom line, the product of more Australians in work and fewer Australians on welfare. Gross debt as a proportion of GDP will peak lower and earlier than that was forecast in MyFO at the end of last year. Gross debt will not only stabilise, but will decrease over the medium term. This is the fiscal dividend of a strong economy. We have already seen the benefits of this approach and what it can deliver to our overall budget position. With the final budget outcome for 2021 around $80 billion better than the forecast I delivered in the budget in October the previous year. The primary driver of this $80 billion improvement was a stronger than expected labour market. As I've said before, provided nominal economic growth exceeds the nominal interest rate, economic growth will more than cover the cost of servicing our debt interest payments. As a result, by growing our economy, we can sustain and maintain a steady and declining ratio of debt to GDP, even without running surpluses. In this budget, our revenue forecasts will continue to be based on a conservative set of commodity price assumptions, which return to their long-run anchors. Notwithstanding the current elevated levels which we see with iron ore at over $130 a tonne, thermal coal at a record $385 a tonne, and metallurgical coal at a record $660 a tonne. These prices for thermal and metallurgical coal are more than 50% and 60% higher than previous record highs seen at the end of last year. This is a responsible approach to commodity assumptions that protects the structural integrity of our budget. It prevents new structural spending being baked in off the back of temporary revenue increases. When Labor was last in government, they did adopt the opposite approach, recklessly locking in over their 4-year forward estimates extraordinarily high iron ore spot prices, which were at the time around $180 a tonne. Our tax to GDP cap of 23.9% remains a key element of our fiscal strategy. This imposes a discipline on the expenditure side and is consistent with the Coalition's values of cutting taxes, not increasing them, enabling Australians to keep more of what they earn. If Labor had won government at the last election, their $387 billion of higher taxes would have seen the tax to GDP ratio increase to a record high 25.9%. In this second phase of our fiscal strategy, we will also continue to control expenditure growth, maintain our focus on the efficiency and the quality of government spending, while guaranteeing the delivery of essential services. We will also continue to support productivity-enhancing investments and structural reforms that build a stronger economy, support private investment, and create more jobs. This year's budget will see a continuation of our economic plan, with further investments in infrastructure, skills, the digital transformation, our regions, energy, and manufacturing. While Australians can be confident about their economic future and the underlying resilience of our economy, what recent years and indeed months have shown is that we live in very uncertain times. It's a reminder that we must take the opportunity, while the economy is strong, to strengthen our budget, to rebuild our fiscal buffers, and to ensure that we have the fiscal firepower to respond as needed. The pandemic is still with us, and new variants may emerge. There is war in Europe with heightened geopolitical risk, which does threaten global growth. Together, the pandemic and events in Ukraine are straining supply chains and driving up energy prices and inflation. As we saw entering this crisis, a strong budget and a strong economy put us in the best position to respond. That is why it's important to move to the next phase of our fiscal strategy, which will stabilise and reduce debt as a share of our economy. Australia has sustainably reduced Commonwealth gross debt as a share of the economy 6 times in the past century, following the 2 world wars, the Great Depression, and again following the recessions in the 1970s, 80s, and 90s. The consistent lesson from these successful fiscal consolidations is that they are almost always achieved gradually and are underpinned by a strong economy and genuine fiscal discipline. A gradual and measured pace of consolidation ensures that the economy can continue to adjust and grow even as fiscal policy normalises. It's about striking the right balance. A sharp and a sudden tightening in the fiscal settings would likely be counterproductive, undermining the economic recovery and ultimately hurting the budget. We do not want to put at risk the hard-fought gains we have made. The government is in a position to take this measured approach because of our strong fiscal starting position. Our debt to GDP levels, even when they peak, are still low by international standards, below the OECD average and around half of that in the United States and the United Kingdom. Even as interest rates gradually rise, our debt servicing costs remain manageable, with the AOFM having been able to take advantage of historically low interest rates to borrow at the longer end of the yield curve. This makes our debt repayments less sensitive to future increases in interest rates. The weighted average term to the maturity of Treasury bonds is now over 7 years, compared with less than 5 years a decade ago. Despite the size of the economic shock, Australia has also retained its AAA credit rating from the 3 leading credit rating agencies, one of only 9 countries in the world to do so. The recovery will also continue to be supported by significant fiscal support that is already in the system. Household and business balance sheets are substantially stronger than before the pandemic. There is now, and this is quite a remarkable statistic, an additional $251 billion accumulated on household balance sheets and a further $182 billion on business balance sheets that was not there at the start of the pandemic. This will continue to provide confidence for people to spend and to invest to the benefit of our economy. In conclusion, our economic and fiscal strategy has worked. It has served us well throughout the pandemic. A strong economic recovery is now underway, with the unemployment rate on track to a 50-year low. Given this strong outlook and given emerging inflationary pressures, we have drawn some clear lines. The time for large-scale, economy-wide economic stimulus is over. We are sensibly transitioning to the next stage of our fiscal strategy, beginning to rebuild our fiscal buffers. We're at the same time sticking to our economic plan, investing in our future, creating more jobs, and guaranteeing the essential services that Australians rely on. Thank you very much.
for some photographs, which we'll conduct just back up outside the doors for a few people if you'd like to take that opportunity just to meet the Treasurer and just take a few photographs. But to open the ball running on some questions, the Treasurer, perhaps the first one, I'll get started. In your speech, you referenced some of the pressing international challenges that the Australian economy is facing at the moment, the residual impacts of the pandemic, the tensions we're seeing in different parts of the world, including the South China Sea, war in Europe, rising commodity prices, energy costs, supply chain pressures, the like of which we haven't seen really since the mid-1970s, the impact of the oil shock. In those circumstances, as you talk about moving fiscal policy to the next phase, how is it that the government sees that it can continue to firewall the Australian economy against some of those really pressing challenges?
Well, thanks, Andrew. Interestingly, overnight, there was an OECD report out about the economic impacts of the events in Ukraine, and they've suggested that global growth will be hit by about a 4%. And the IMF had previously talked about the consequences for global growth as a result of the issues in Ukraine. It's having an impact in a number of ways. Obviously, it's driving up key commodity prices. So European gas is up by around 50% since the crisis started. It's been fluctuating. And then you've also seen coal prices up substantially similarly, and you've seen wheat prices up substantially as well. That's going to flow through to higher inflation around the world. And again, the OECD have said in the report today that it would have a very significant impact on global inflationary pressures. That then puts more pressure on central banks, and you would have seen the Federal Reserve moved overnight by lifting its interest rates, and certainly central banks, I think, are looking for an opportunity to normalise their monetary policy settings, just like we're looking to opportunities to normalise our fiscal policy settings. So I think you're going to see higher inflation. You're also going to see greater uncertainty for the overall investment climate. And then for us here at home, we're not as exposed in our trading relationships. I mean, Ukraine and Russia combined make up about 0.2% of our overall two-way trade. But that's not the case for Europe. And the biggest issue sitting in Germany right now or other European countries is what do we do about our heavy dependence on Russian gas and energy exports? And so I think there's going to be some real fundamental issues that Europe are going to have to deal with in the immediate term, which could then have a knock-on effect for global growth, about whether they'll accept higher energy prices and diversify supply because they don't want to be fueling the Russian aggressive military machine. So there, I think, some of the issues. Longer term for Australia, we have already started this process, but I think this will be accelerated for other countries, which is how do you build into your supply chains real resilience to ensure as far as you can against this type of geopolitical risk. As we know, through globalization, it was a just-in-time approach by businesses and indeed governments to find suppliers, often single suppliers, that would provide them with the product. I don't think we can afford that anymore. I think we have to think very carefully about our supply chains, ensuring that we both have a diversity in our suppliers, but also that we have reliable and trusted partners to supply us. So we've identified the areas where we need to focus on this. For example, pharmaceuticals. For example, telecommunications equipment. Certainly energy imports are a major issue for us. We've got 2 refineries and we import a lot of our fuel. We're a net exporter of food. So we've got plenty of food. For 26 million people, we produce enough food for 75 million people. But we are going to work even more closely than ever with our international partners to try to devise supply chains which are more integrated, more reliable, and more secure. And that may, in the first instance, involve further investments in our own sovereign capabilities. But ultimately, I think it's going to produce a better dividend for the economy longer term because it's going to give that security of supply. I've talked about it before. It's moving from a just in time to a just in case approach. So if you ask me, what are the big two takeouts economically? Well, there's actually another one, but the big two takeouts economically are inflation and supply chains. And then I would just make it an aside comment. What we've also seen here is the need for countries to further invest in defence. Again, it's a trajectory we're on, but Europe is going to do that. So if you're investing more in defence, then you're going to have less money in other places across the budget. And then the second thing is we've seen economic warfare in a globalised context play out here in this conflict in a way we've never seen it before. And what I mean by that is how quickly the international community moved in unison to isolate the Russian regime with sanctions that froze their foreign reserves and their central bank's ability to sell them down to support what was a currency in free fall. And now the Russian stock market is closed and remains closed. And, the Russian economy is being damaged very, very significantly. So I think there's a lot of takeouts of what's happened in Ukraine, economic warfare, further spending on defence, supply chain resilience, and then for Australia and the world, higher inflation.
We might circle back to that question of the impact of higher prices and the risk of inflation. The other thing, just picking up on what you said there, and I mean the role that the Australian government's played in terms of those international sanctions, I think we can say categorically from an Australian business standpoint, the business community is certainly very supportive of what the Australian government's doing in that space. I think we understand there may be some economic knock-on from that we'll see, but it has to be done. And I'm sure that across the Australian community, business community, there's wholehearted understanding and support for that. Next question, I'm going to invite Karen Sobels, the President of the Victorian Chamber of Commerce and Industry. Karen, you have a question.
Thanks, Andrew, and thanks, Treasurer. I think it's fair to say 18 months ago, nobody thought we'd be sitting here with 4% unemployment and with the state of the economy we've got now. So it's fair to say the strategy has worked. So congratulations on that. Certainly with the $430 billion extra on the balance sheets, there's great potential for springboarding. But SMEs, as you've mentioned, SMEs are finding that we are in the worst bottlenecks for supply chain and costs in supply chain that we've had, some say, since 1974. And you mentioned inflation. The cost of doing business is rising. It's rising quickly. What do you think? And I know you've already mentioned the supply chain issues, but what are your thoughts around the supply chain issues and how that's going to affect inflation and what that might look like over the next 12 or 18 months?
Well, earlier this year, we kicked off a productivity commission review into our ports because our ports are less efficient and less productive than the international benchmark. And the ACCC, the World Bank, and others have done a lot of work in this area. We would like to see a lot more efficiency in the work practices in our ports. As well as the infrastructure settings, and that will then flow through to ultimately lower freight costs and flow through to companies. But in terms of supply chain bottlenecks, I mean, as you know, crates and the like are in high demand, and I know there's a focus from companies to start producing more of those. And we've made some initiatives around the timber industry, which can help in that regard as well. But again, what we saw during COVID was consumer behaviour change. And because everyone was subject to health restrictions, you couldn't go out and consume services in the normal way. You couldn't go to a restaurant. You couldn't take a holiday in the normal way. So instead of consuming services, you used your money to consume goods. Now, those goods were in high demand, and therefore that clogged up supply chains. And that flowed through here in the form of higher prices. We've also seen, as a result of COVID, you've seen absenteeism from workplaces, and that slowed down manufacturing and production in everything from sort of microchips, for example, which then meant that you would have to wait longer for various car parts or whatever the case may be. So there has been an impact from COVID around supply chains, which I think will ameliorate as we get back to living safely with COVID. And I think that will have an impact. And then, of course, if we can get some more longer term structural changes based on productivity commission work into our ports, I think that will be better off too.
Great. Thanks very much. I think we've got time for a couple more questions. I see Paul Zara, the Chief Executive of the Australian Retailers Association, with a question. Paul, please go ahead.
Thanks, Andrew, and thanks, Treasurer, for your speech. And I also wanted to commend you personally on the work you did and your leadership right through the COVID crisis, because retailers do appreciate your efforts and how the economy is in such good shape. My question is, we're living in an era of continuous disruption, with climate change the greatest disruption the business has seen. How is the government preparing to educate business on preparing and adapting to the impacts of climate change?
Well, our prudential regulators have established new rules, and that is around climate-related disclosure, and I think that's important. Our banks are certainly factoring it into their decision making, and we as a government have set nationally a net zero target by 2050, which I think is a very important part of our response, because it gives the certainty for businesses to start preparing for that transition. And what you'll see in the budget is further investments in that transition in the energy space. But there's certainly a much greater awareness by investors, by international money markets, about the impact of climate change on financial decisions. And I made a speech about that ahead of our decision around net zero by 2050. That if we didn't adapt that target, then adopt that target, then I think it would have meant a higher price for Australian borrowers, and certainly in some industries where they wouldn't have been able to access tier 1 capital, they would have had to go for more expensive tier 2 capital, for example. So our prudential regulators are doing things. There's a lot of work on the climate disclosure piece, and from a government's perspective, we're setting out that roadmap with our technology investments. We've identified the big areas: carbon capture and storage, large-scale solar, batteries, obviously hydrogen as a new frontier for us, as well as a means of reducing that carbon footprint, but also creating jobs.
I'd like to provide the opportunity for one more question. I see a hand over here, so please go ahead, and if perhaps you could just introduce yourself, that would be great. Thank you.
Thank you. Good morning, Treasurer. Elizabeth De Soma from Medicines Australia, representing small, medium and large pharmaceutical companies in the research area and innovation. I'm very glad you called out pharmaceuticals as an area of interest, and we know that the current government is very invested in pharmaceutical development as part of the economic recovery. I was interested in your speech, and thank you, and again echo the commendations on the way that the economy is looking, but your transition to a new fiscal arrangement, which talks about reducing unnecessary expenditure, and one of the areas that might include is health. And yet during the last 2 years, we've seen that health is an engine room of the economy. And you have even called out pharmaceuticals as part of that growth of the economy future. How will you manage curtailing spending on health when it is a requirement for businesses who invest in health to have a good market access environment? So how will you manage that, reducing spending on health and yet increasing investment in health, particularly as health has been seen as part of our national security?
Well, actually, you'll see further investments in health. So this budget will be putting more money into health and our health response, not less. And that has been our track record as a government, whether it's hospitals, whether it's through the crisis with the purchase of vaccines, the testing and tracing arrangements, the use of telehealth, which has been revolutionary for the health sector and obviously for patients as well. So you will see more investments in health, not just as part of the COVID response, but overall. I think we have a really good story to tell. One of them is around listing drugs on the pharmaceutical benefit scheme. Unlike previous governments where they may have chosen which drugs they listed, everyone that is recommended to us by the official advisory panel, we've been listing. And that obviously has a significant cost to the budget, but it's of huge benefit to families. Drugs that may have otherwise cost $6,000 or $7,000 for a course are now, $40, or if you're a concessional card holder, it could be, a fraction of that. So we'll list more drugs in this budget on the pharmaceutical benefit scheme. We'll invest more in health as we've done in this budget. I just want to make it very clear. This budget will show an improvement in our bottom line, not as a dividend, not as a result of cuts, from the opposite, as a result of a growing economy, as a result of more people being in work, therefore paying tax, and less people being on welfare. That's what this budget will show. I couldn't have been clearer in the speech. It's not a time for austerity, right? It's not a time to be pulling money out of the economy. What it is it to normalise your settings by moving off emergency support payments and then banking some of the dividends of this growing economy. That's how you see the improvement, with gross debt as a share of the economy peaking lower and earlier than what was forecast at MAIFA.
Thanks very much, Treasurer. So look, we are right on time. What I'm going to ask, of course, we've been very grateful today to be co-hosting with the Canberra Business Chamber, and I know there are many members of the Canberra Business Chamber here in the audience today, which is great to see. So I'm going to invite the President of Canberra Business Chamber, Archie Siramokas, to provide a vote of thanks to Federal Treasurer.
To say a few words to thank the Treasurer for what he has done, not the least of which is being here today. But I think I might start with saying thank you for your sleepless nights over the last couple of years, and without which I think the results that we're hearing about today and we are aware of generally would not have been possible. We certainly all appreciate your great engagement with ACCI and business generally. And we certainly believe that you understand the issues facing business, and that's something for us which we value greatly, and we certainly thank you for. We certainly, and I'll echo the comments, and I think people have already said the things that are most important, is thank you for the results that you've been able to achieve and getting us to the point we are today. As you mentioned, that we are at the very, very top of countries around the world in terms of where our economy sits, where we are in terms of unemployment and other economic measures. So, on behalf of certainly business, but the broader community, we'd like to thank you and your government for all of that. And we certainly would not have anticipated being in this position, but for all that incredible work. So, Treasurer, thank you. Thank you for your participation and an ongoing commitment to business. And we look forward to seeing the announcement of the budget in 11 days' time, and look forward to you going very well in the election in a few weeks' time.